Hi everybody, this is Mr. Farmer with AP Macroeconomics, and today we're talking about balance of payments for foreign exchange markets. Here we go. So first off, balance of payments. What are they? They are financial statements of all international flows of money over a given period of time. It consists of two major statements: the current account balances, which are kind of these ones up here over in blue. So we have pretty much the exports and imports. That's going to be the biggest portion, called balance on goods. It also includes imports and exports of things like services. Those kind of combined are the largest two, but there's also two other ones which we'll deal with a little bit. The second part of the balance of payments is called the capital or financial account balance. There used to be two separate things. Nowadays, they're usually just considered as capital account balances, and they kind of can be combined to do the same thing. So here are the capital account balances. So we have the capital and then also the financial, because in this point, they were two different things. And then here's the main thing. So if you look at the balance on current accounts, this top part, you balance all of these numbers out, and you balance out the capital and financial accounts, what you find is that the balance of payments is 0. So the idea is that the current accounts are balanced out should be equal to the capital financial accounts. So a surplus in the current account, meaning you export more than you import, would mean you have a deficit in the capital financial account. So they do in fact balance out. So current account balances on goods and services. The balance on goods, the difference between its exports and its imported of goods by monetary value. Balance on services, difference between exports and imports of services, such as things like insurance, consulting, travel, brokerage, cloud systems, those kinds of things. So pretty much net exports, that's what we're looking at. Exports minus imports. So the balance on goods, balance on services, you sum those up and you get the actual current account balances of, in this case, negative 805. So the current account balances are, again, the balance on goods, balance on services, and these other two things, net investments and net transfers. When you do all that, you get the current account balances. So again, the current account includes this net income thing, which is the net profit. Pretty much companies do business internationally, and so that money gets transferred back over to them just as profits. And so it's the earnings from abroad for your international business. Not really a good or service being moved. It's just, hey, we owe you this money because you worked in our country and we pay that. Same thing for the net figure on payments to loans. Again, the net simply means adjusting all the costs and taxes and everything else. So again, here we have the net investment income, NII, and net transfers. Here's the thing. The net income and net transfers combined aren't as large as exports and imports, and realistically they really aren't that big of a thing, because that goes back and forth and back and forth. You can see on this example the balances on goods and services was 730 some odd dollars, and then the net investment, net transfers was simply $81. So not really that big of an issue. For this reason, we in AP College Board really do focus mostly on the net exports, the exports minus the imports, and that's really what we kind of do focus on. With that said, this equation down here, if you're given a balance sheet, will be the case. I doubt you get a balance sheet though, to be honest. So current accounts. Okay, let's do a little visual. What does this mean? So let's say the United States is going to import goods from China. So, ta-da, imports of goods. What's this mean? The capital we're looking at for the current accounts is the money. So this would count as a current account deficit for the United States. Why? Because we follow the money, not the goods and the services. So the United States would have a deficit in the current accounts because typically, this is why I use the United States and China, the United States imports far more than we export. China, on the other hand, would have a surplus current account because typically China exports more than they import by monetary value. So that's what we're looking at. We're keeping track of where the money goes in order to buy the goods and services. Now this is the net exports, so again there's lots of transfers back and forth, so overall where does it land? So the current account is, in this case, because the United States spends more money than it has coming in from the net exports, the United States would have a deficit. On the other side, we have the capital financial accounts. So the capital financial accounts measure the net flows of financial claims. It includes transactions in financial instruments and central bank reserves. Again, what we're doing is we're following the money. So the flow of money to pay for things like assets, and instead you get ownership of assets exported to, again, China. What do I mean? So based on the net exports from that current account, China has a surplus in its current account, which means it has more money than it spends. So where does that money go? Well, they're going to loan it out. How do they loan it out? Well, they're going to go ahead and buy securities like bonds from places that, like the United States. Why? Because when the United States sells the security to China, instead, China has money flowing away from it into the United States. This is probably why China, of foreign countries, is the about third largest next to United States in internal ownership of bonds is China. Why? They have such a high current account surplus that they have extra money they can lend out. So China will be a lender, and the United States would be seen as a borrower because they usually run this. So China will invest money into the United States assets like security stocks. So this will count as a positive current account capital account balance for the United States because again the money is flowing from China into the United States. They have money flowing into this. This is how we have enough money in the United States to then buy all the stuff we import because by the United States itself there isn't enough money. They have to borrow it. So we're saying they borrow it in the capital account from China. So again, there's really two parts to this. The capital and financial accounts. Again, at this day, we usually just use capital, meaning money. We're looking at the money, not like the machinery being used. So what is this capital? What is this money being used for? For the capital account, or it's a record of a transaction of an asset with the intention of purchasing capital. For instance, if a foreign company invests and buys a factory or a building in another country, they buy ownership of that asset. The factory and the building still stay in the other country, but the ownership of the asset has been transacted. So I've sent capital in order to own that asset. The financial account is just for financial uses. So record of transactions of money to purchase or sell financial capital. You buy a security, you buy stock, you buy bonds, you buy whatever other thing it is in this other country. Essentially, I'm going to buy ownership of an asset, interest-bearing asset, for instance. In exchange, I'm going to provide you money. So this is kind of the balance of payments. The amount of money that we have to pay, we import when we export, so we're going to pay money somewhere in the current account balances. How do we get that money? Well, we provide ownership of resources, assets in the capital or financial account balance. In exchange, we have enough money flowing in here. Again, this is the capital account down the bottom. We have enough money flowing in to pay for this amount. So, what's the big takeaway? The current account deals with the receipts and payments in cash. The capital account reflects sources utilizing in the capital. So, the sum of the current and the capital account will always be zero. So the balance of payments will always be zero. This means any surplus or deficit in the current account is matched and canceled by an equal surplus of deficit in the capital account. So again, a surplus in the current account, you export more than you import. What does this mean? You as a country have more money. So what can you do? You can lend that out to people. So China typically has a current account surplus because they export more than they import. That means they have a lot of money, and so they can lend it out. So they'd be a creditor internationally. Germany typically has a positive or a surplus current account. So they lend, have a negative or deficit in capital account. They have money flowing out as they buy more resources. The United States typically runs a deficit in the current account. We import more than we export. So we'd have a surplus capital, meaning we have more capital, that'd be the cash, flowing in. In exchange, we sell assets, financial or actual like ownership of buildings, this is an example of capital, to other places. And so we can kind of see this, okay? Again, we have the identifies the flow of money to purchase or sell goods for the balance on trade, or for services. These are actual goods, actual services going between two different countries. And so you have the balance. And then you have this unilateral transfers. That's the net investments, net income stuff. So again, not a big thing here. And so that's our balance. Essentially, net exports. Down at the bottom, because this country, whoever it was, exported more stuff than they imported, that means they have more money flowing in from their net exports. So what can they do with that money? They can lend that money out, meaning they're going to invest in foreign assets. So domestic investment in foreign assets, they're going to have money flowing out of their country as they purchase more investments. And then foreign investment, yeah, people would still invest into this country, but not as much. And so we can see when we add the current accounts to the capital accounts, we get almost the same. Now again, for our purposes in College Board, they will be identical. We'll have a balance of payments. Realistically, because of things like exchange rates or just because of how complex it is, it might not actually be exact. And so sometimes you will see this statistical discrepancy. That's because there's a lot of information. But for our purposes, for AP Macroeconomics and College Board, a balance of payments will be the same. So what's the main takeaway? If you have a positive current account balance, you'll have a negative capital account balance, and they do, again, balance each other out. Next time, Forex markets and the graph. See ya.